In September 2008, most people were not watching Wall Street. They were at work, at home, planning ordinary things. Few realized that inside a series of conference rooms in New York and Washington, a decision was being debated. It would ripple across the entire planet. It was not a military decision. It was not political in the traditional sense. It was financial. And yet, it would change governments, careers, savings, and futures. The decision was this: should Lehman Brothers be saved or allowed to fail? Before the fall, in the early 2000s, the mood was confident. Housing prices were rising. Banks were lending freely. Credit was easy. Owning a home became not just a goal, but an expectation. Mortgages were handed out to people who, in another era, would not have qualified. But the risk did not stay in local banks. It was packaged, sliced, repackaged again. Financial products were created from those mortgages, complex instruments that promised steady returns. On paper, the system looked stable. In reality, it was fragile. The illusion of safety Wall Street believed it had mastered risk. Models predicted outcomes. Ratings agencies stamped products as safe. Investors around the world bought in. The belief was simple: housing prices do not fall nationwide. It had never happened before in modern history. And if it had never happened before, it seemed unlikely to happen now. Confidence is powerful, sometimes too powerful. Cracks begin to show. By 2007, defaults were rising. Homeowners began missing payments. The complex securities built on those mortgages started losing value. Banks realized they were holding assets that were not as safe as advertised. But no one wanted to be the first to admit it publicly. Markets dislike uncertainty, and uncertainty was spreading. The pressure builds. In March 2008, Bear Stearns, a major investment bank, nearly collapsed. The U.S. government stepped in to help facilitate a rescue. The message seemed clear: systemic institutions would not be allowed to fail. Markets calmed temporarily, but the underlying problem remained. Lehman Brothers was next, inside the decision room. By September 2008, Lehman Brothers was on the edge. Losses were mounting. Confidence was evaporating. Investors were pulling back. Government officials and financial leaders met repeatedly. The question was blunt: should taxpayer money be used to rescue another bank? The rescue of Bear Stearns had already drawn criticism. Moral hazard became the phrase of the moment. If banks believed they would always be saved, what would stop reckless behavior? Allowing Lehman to fail, some argued, would send a message. Markets must discipline themselves. Consequences must exist. It was a logical argument. It was also a dangerous one. The decision. On September 15, 2008, Lehman Brothers filed for bankruptcy. The government did not intervene. For a moment, the decision seemed controlled, contained. Then reality moved faster than theory. The domino effect markets panicked. Interbank lending froze. Credit markets seized up. Companies that relied on short-term funding suddenly could not access cash. Stock markets plunged globally. It was not just a Wall Street problem anymore. It was a global one. Factories slowed. Businesses cut staff. Families lost homes. The system had been more interconnected than anyone fully understood. Lehman was not just a bank. It was a signal, and the signal triggered fear. Human consequences. For executives, it was strategy. For ordinary people, it was survival. Retirement accounts shrank. Savings evaporated. Unemployment rose. The crisis spread from financial centers to kitchen tables. Trust in institutions weakened. Anger grew. The phrase, "too big to fail," entered public vocabulary. But after Lehman, the lesson seemed unclear. Was it too big to fail, or not big enough to save? A shift in policy. After Lehman, the approach changed. The U.S. government quickly moved to stabilize other institutions. AIG was rescued. Banks received emergency support. Central banks lowered interest rates dramatically. The fear was that another collapse like Lehman would push the system beyond recovery. The irony was difficult to ignore. The attempt to enforce discipline had triggered greater instability. Was there another choice? Looking back, economists still debate the decision. Some argue that Lehman had to fail, that constant bailouts would have been worse. Others believe that allowing it to collapse was a miscalculation, underestimating systemic risk. At the time, officials were operating under intense pressure. Information was incomplete. Time was limited. The cost of action was visible. The cost of inaction was theoretical, until it wasn't. The long shadow. The 2008 crisis reshaped financial regulation. Capital requirements tightened. Oversight increased. But it also reshaped politics. Distrust in financial elites grew. Populist movements gained traction. Economic inequality became a louder conversation. The decision regarding Lehman was not the sole cause of these shifts, but it was a catalyst, a moment when theory met reality. The real lesson. The collapse of Lehman Brothers did not begin the crisis. The fragility had been building for years. But the decision not to intervene transformed stress into panic. It revealed how interconnected modern economies had become. It exposed the limits of prediction models. And it reminded policymakers that sometimes the consequences of a principle can outweigh the principle itself. Closing in 2008, the world did not collapse in a single explosion. It unraveled. Slowly at first, then all at once. The decision to let Lehman Brothers fail was made in conference rooms, with spreadsheets and forecasts. But its effects were felt in homes, factories, and streets across the globe. It was not a decision made lightly, and it was not made without reason. But history rarely judges decisions only by intention. It judges them by consequence. And in 2008, the consequences were global.